Hello, Harmony Traders. Today we're going to be discussing two signals, the railroad and the trigger trade. This signal, both of them work very good at initiating a position, especially the railroad, and also as a continuation trade like the trigger trade. Very similar in structure. The difference between them is location. And we're going to dig deep today and discuss. And hopefully, at the end of this presentation, you get a deeper understanding of how this signal work and how you can benefit from it. So let's take a look. All right, traders. One of the things, let's start off by talking about the difference between them. What is a railroad? What is a trigger trade? And why are they something that we are very interested in pursuing as a signal in trading? Railroad is a reversion to the mean type of a trade, where the market has shifted its personality, and for the first time, as a premium signal, it went back up to retest uh, the middle of the range type of behavior. Now that when I'm talking like that, I'm talking about a short signal. If it pulls back into that level from after a breakout, then that would be a long signal. But ultimately, just the basic understanding of that signal, it's a reversion to the mean type of a behavior where the market has broken either above or below the range and then pulled back to the middle of the range as a reversion to the mean, and then you're getting a positive test of that behavior. Now, the trigger trade, it's exactly the same behavior. However, it does not reach the middle of the range the way a railroad does. And in essence, by not doing that, it gives it a weaker characteristic. That we look at that type of a signal as a continuation trade to an existing position that you showed profitability in, versus a trade that or a signal that you initiate a position with, like a railroad. So we're going to take a look in greater depth at the differences between them and look at examples and how to measure risk and look for targets in both. Just a basic understanding, a railroad is a minimum. The market has to, at a minimum, move a couple of candles in the upward direction in case of a short signal, a minimum of two, then a pullback that closes that candle. We have that behavior touching the middle of the range. We say that is a railroad short. If that behavior of two candles up on a one candle behavior actually does not reach the middle of the range, then that is a trigger trade. Okay. So the rules are a minimum of two candles, then one candle reversal. Okay. So let's move on. And what makes a signal a premium signal versus not a premium signal is location. So if a railroad short, for example, where the market runs up to the middle of the range and pull back, that condition exists and a minimum of two candles. Then the second condition where that behavior happens at the beginning of a new harmony wave, then that would define it as a premium signal. Now you have to add to it as well the 200 NT Rinko and the 100 NT Rinko in the case of NQ as a definition of the environment. When that happens, then you're really looking at that point at the best possible type of setup. So if you ask yourself a question, if you have one trade to take today, what would that trade be? And if you decided that the railroad is that type of a signal that you will take it no matter what, then you ought to take the best possible formation of it that has the best capacity to generate a positive outcome. Now we know that that doesn't mean necessarily that each trade works. However, you want the highest probability environment, and that's defined by the actual 200 NT wrinkle and the 100 being in sync. Sometimes you may not get that. I will be happy with the 200 being in the direction of the signal, even though the 100 has not come online yet. So at a minimum, you have to have that. But if you have both of those conditions together, then ultimately that generates a much better signal. So let's revisit that. Okay. If if I have one trade to take today, and I decided that, hey, railroad is the way to go, I'm looking for 200 NT wrinkle and the 100 are in sync in NQ. If I'm trading ES, will be the 50 NT wrinkle and the 6 and 3 NT wrinkle. Those are in sync. So now that's condition number one. Condition number two is you have to have a minimum of 2 candles up that reaches the middle of the range. And I'm going to show you graphs that shows this. And then a 1 candle reversal. Then you get your entry and you're looking for multiples of your risk. Now, a trigger trade is just the same exact formation. It just doesn't hit the middle of the range or the what we call the purple line, which is the middle of the range. So that gets us to talking about risk and targets. So the one, if I'm in the condition of all these conditions are present, and then you get a 1 candle reversal, and I get in there, what is the most conservative risk profile that I can put together that will lead me to say, hey, the conditions has changed? It will have to be a 1 candle reversal against my existing position. And if that happens, then I can say comfortably, hey, listen, the market has changed or starting to change, and this is the minimum risk profile that I can take. Now, when you're aware of the 5 lines of defense in a harmony wave and in a cloud, it gives you more opportunities to manage that trade at multiple levels, right? So, but that's something that we'll discuss on a later video. But if you're risking that 1 candle, you're looking at multiples of that candle in your behavior, in your direction. So you're risking on the 20 NT wrinkle railroad, you're looking at 10 points. So you're looking at 10 to 20 points as far as profit target. In some volatile markets, you are gonna try to, in an average market, as far as targets, you can look from 1 to 3 at the harmony swing trade indicator. You start looking at those 1, 2, and 3, TP1, TP2, TP3 as the targets to look for. You want the signal to happen between entry point or entry price and target number 1. If you manage to find that quality of a signal, those are the highest probability because it's coming in at the beginning of the establishment of a new harmony wave and also a new cloud positive. Okay. Now, you will find out that some of these railroads also happen later in the trend, and they will have a different type of value when it comes to how aggressive I will take those trades and how much size would I put in them. So if we can get the signal between entry price and target number 1, that's by far the best possible scenario. Now, let's look at examples. This is a long one, a long railroad trade, and we can see a couple of things that's they're happening. You have the 200 and the 100 are in sync. You have the pullback of a minimum of 2 candles, and actually this one happens to be a lot more. That's 1, 2, 3, 4, 5, 6. You got 6 candle pullback, then a 1 candle reversal hitting that middle of the range. And that's the middle of the range that we're looking for. You're getting a reversal candle, then you're getting a switch trade, you're getting a pullback into a signal here, which is a trigger trade, and also into a switch trade for higher prices. So you're getting a lot of things going on here, but obviously we're just focused on the railroad right now. And uh, the fact that the 200 and the 100 are in sync, that's great. It's not a premium entry because we're this happened at the end of this harmony wave, and you really want that type of setup to happen exactly here. Yeah. And but you wanted the pullback to be deeper, and you want to get closer or touching that middle of the range behavior that we're having. So this is a good signal that produced um, a, a premium signal. Will look a little bit different, but that's just a good railroad uh, retest of this breakout. And you could see also right here that the market did similar thing. And that's also, a very decent railroad pullback into the signal. And you take that signal one tick above the close of that candle, and you're looking for multiples of that risk, which is about 10 points in the direction of the overall trend. Now, that's a railroad. So what is a trigger trade? I mean, it's the same exact behavior, but it does not touch the middle of the range. So that would be right here, a trigger trade. So how would we handle this kind of sequence? I mean, you have, for example, this pullback into this railroad long. Multiple contracts can lead you into this signal. So you're always using the follow-up signal as an adding opportunity to an existing trade that you made money off of. So if you're in a couple of contracts here and the market runs up and you sell that one contract, the market pulls back, it gives you another signal. You add what you already exited, and you keep your core, and the market runs up and you exit. Then you get into this railroad long, you add here on a switch trade, and off you go to a target, trigger trade, switch trade into a target. This is another trigger trade, another switch trade. So I mean, that one, as an example, probably an outlier event, but you get the point. You want to build on the successful position whenever you catch one. You get into one trade, you make your money, and you add as the market give you more signals. So a trigger trade, in essence, is a continuation trade, and a railroad is the one that you establish your position with, and the trigger trades are the one that you add to. I mean, it could be a trigger trade or railroad or captain setup. It doesn't matter, but you start with that and you move on along with the signals that are in sync with the overall trend that you're seeing. So now here, when we are looking at the short scenario, I mean, if you want to take a picture of something that really is a premium behavior, this is exactly what I'm looking for. And I'm looking for a behavior where the market has shifted for the first time from an upward momentum to a cloud that is negative. And this is the first test of the middle of the range, making it a railroad short. And you have the minimum of 2 candles and then the 1 candle reversal. Now, one observation here is the fact that the market here is so tight and constrained that it really makes your exit in case of a stop out a very legitimate stop. Why do I say that? Because if you have a cloud that it has a big size to it, then you're going to find out that your risk becomes the size of that cloud. And whenever you have a market that is very tight, that means that the market spend a lot of time consolidating around a range. And then if this candle to flip back up, you pretty much are taking out about 4, in this case, actually 3 of the 5 lines of defense. So the 2 that's left are, I mean, let's go over them. The oracle, the harmony wave. That's the gray zone. That's the first line of defense. The second one is the middle of the range. That's another one. The third one is the top end of the cloud. The fourth one is this trend line. And the fifth one is 10 points above the cloud. So you can see right here, a one candle reversal will pretty much kill that trade. It tells you very quickly that it's, it's done. Now let's assume the signal got generated here, right? Then what would be my risk? Would be, the 65 to the 95. So that's a 30-point risk, while this one was about 12-point risk. So you're really cutting your risk by 50% by coming in at the beginning of a new harmony wave and also getting this tight, consolidated coiling behavior where an exit, or if the market flips automatically, that the market most likely is going to continue higher. So it's very important to position yourself as early to this beginning of the new harmony wave as possible. Now, in this example, you could see that you're getting a trigger trade where the market ran up and pulled back. Now you're getting another short railroad into a switch trade, and both of those paid, and that's a premium switch trade as well. Then the market gives us another railroad, and guess what it does? It gives us a switch trade. So automatically you're thinking in terms of short, and then the market flips and gives you a captain setup long, then a captain setup long with a switch trade long. Now that as a formation, it's a failed formation from the short perspective, and the market is making a counter trend into higher prices. So that should tell you right there that if you happen to find yourself in this position, that you need to be out of this trade. But look at the characteristics of that trade that failed. You're not at the beginning of a new harmony wave. So that's why that is important. Look at the difference between this signal here and this signal here. What's the difference? The difference is this is happening at the beginning of a new harmony wave, while this signal happened at the conclusion of that small harmony wave. So right there, it tells you that the personality shift, but it's confirmed by those two follow-up behaviors of a captain setup long and a switch trade long. And if you hear me in the room talking about that, captain setup switch trades are a very strong behavior, and typically you get a very decent reaction off of it. So just be aware of the importance of location, and it's worthy or worth your time as a trader to think in terms of, if I have only one decision to make all day long, and you will wait for it, what would that be? And again, if it happens to be the railroad, then make sure all the conditions are lined up to make that trade the best possible decision you'll make for that day. Because if you make that good decision initially as the first trade, it just puts you in a different mindset. Like we always talk about, you should treat each trade independently, and you should just trade them without thinking about what happened before it and what's going to happen next. That's theoretical. In reality, as a human being, you will find out a lot of traders that if the first trade that they start the day, it's a negative trade, it just almost clouds their thinking, and the subsequent decisions are a little bit shaky. While if the trader starts the day on a good note and he just hit the first trade in a and was profitable, he just gets in a good mood and start outperforming on a higher level. As a professional trader, you should have this detachment, but just for that first couple of trades, you want to put your best foot forward And it's very important for you to wait, give the market enough time to understand it, and then look for these rule-based setups in which a lot of things are lined up in your favor. You know, the 200 and the 100 preferably. You have a new harmony wave and you're at the beginning of it. You have the retest of it over two candles. You got the coiling in your favor. And boom, you're getting in here and you're looking for multiples. And one of these trades can be, you know, fairly lucrative when caught correctly. All right, let's move on to when signals fail, how they fail, uh, and how would you take advantage of that type of behavior? So, not all trades work, right? But how do you minimize failed signals on noise? So, one of the filters that I use that are, you know, fairly reliable is the 100 and the 200 in harmony or out of harmony. You will find out that when the 100 NT wrinkle and the 200 NT wrinkle are not facing the same direction, they're not in harmony, that you get a lot of failed signals no matter if you're going against that direction. I'll give you an example. If the market is short on the 200 and is short on the 100, that means the market is in harmony on the short side. And then you get a railroad long, the odds are that railroad is going to experience at a minimum a lot of noise and or will fail and continue the existing trend. So if I'm going to position myself correctly for the day, then I want all my signals to be in the direction of the 200 and the 100. Even though sometimes you'll see some of these signals that work counter to the 200 and the 100 work. However, over time, over a big sample of hundreds and hundreds and thousands of trades, you are absolutely better off being patient and waiting and just wait for the 200 and the 100 to be in sync, then take the railroad. Here is an example where the 200 and the 100 were in sync on the short side, and then the market did a flushing behavior and quite a big reversal behavior, okay? And then came in there and gave us a railroad long. An entry there is one tick above the close of that candle, and immediately the market reacted and closed against that candle. And we talked about the risk, as this is the most conservative type of risk you take, is a one candle. And then the market flushed and shifted the cloud to a negative, and then the market just continued to oscillate lower and lower and lower. So how could I have avoided this type of a failed railroad? And should I have reversed the market on that failure? I would say that the biggest clue for me as a trader to avoid it was the fact that the market's not in sync on the short side. So that at a minimum should have kept me looking for confirmation. What would have the confirmation here be? A market pulls back, gives me a railroad in a typical in harmony market, that would be on an automatic signal. I would have looked for a breakout, a pullback, and a retest, and look for that test to hold. But neither here or there, this is the signal, and you took that failure and the market produced it. Another area of concern or a behavior of concern is the quick speed of running down then running back up like that. Typically, when the market does a quick flush and a V recovery, it will spend time consolidating. So that is another sign that I needed to be patient and wait and ask for more information from this market. Okay, but let's assume, you know, the trader did not catch on to all these clues and he took it, he gets stopped out for a one candle and he can move on to the next decision and the next decision. Now, as you build up your vocabulary of this trade, you will find certain situations in which reversing this trade into a short would make a lot of sense. For example, if you establish channel number one, channel number two, and this switch trade behavior and this failure, so it started as a railroad and became a switch trade, then this becomes an area that you would reverse the failure into into the momentum that's in sync with the overall 200 and the 100 behavior. Okay. All right, so let's take a look here. All right, now how to define risk, how to look for targets. We discussed that along the way, but you have a railroad, two candle pullback touching the middle of the range and a one candle reversal. The entry is one tick above the close, and it's very important for traders, especially the people who are new to trading, is to avoid putting market orders. Why do I say that? You're a businessman, businesswoman. You are, as a trader, you have cost of operation as a business. Part of the cost is you how much you pay for the goods that you purchased. So you're buying, NASDAQ 100. We consider that as a product. You buy it, and you want to control that cost. So how do you control it? By the price you pay. If you put a market order, who controls the final price to that product? It's not you anymore. It's the market. In fast markets, the market can run up 2, 3 points, 5 points. I've seen it 10 points. So you jumping in there on a market order opens you up to potentially unlimited risk. And if you multiply that behavior by hundreds and hundreds and thousands of trades, then you build up so much inefficiency in your trading and into the cost of your products that's going to affect your bottom line. And you're literally giving money to the market when you should not. Okay. So a good way of doing this is putting a buy stop limit. The stop becomes a limit order at that price, and then you are getting executed. Typically, majority of the time you'll get executed. Rarely did the market just runs up and not fill you. It does happen from time to time, but it's rare. It's a better approach to miss the trade and control your cost of goods versus just letting the market dictate what you should be paying for this. So you get in there. That's very important. You just make sure that if you're trading with market orders, that you change that habit immediately. It will make a big impact on your bottom line. Now, the risk is the one candle reversal and one tick below the low tick of that candle. So that will be right under that wick right here. That would be the stop. And then you're looking for the multiples of that behavior. Okay. Now, let's take a quick look at some of the signals that we saw today and see what are some of the things that we want to look at. So the 200 anti-wrinkle and the 100 anti-wrinkle are in sync on the short side, the majority of the day. So looking at that, we are looking at shorts on rallies and we're looking for premium entry points. So we're going to take a couple of examples just to kind of demonstrate this and go from there. So this is an example of a new harmony wave, and the market runs up 2+ candles and then reverse. The 200 anti-wrinkle and the 100 are in sync on the short side, producing a railroad short, and that one came from 70 all the way to 45, then reversed into another harmony wave. But the difference between those two things, this is going to be a continuation trade because this one is the premium entry. It happened first. It happened at the beginning of the new harmony wave, and all the rest of the conditions are present. And then you're adding to it along the way into the conclusion of the harmony wave. Market disconnects and reconnects, then gives us what? Another one. And when the market is trending, it just produces a lot of this type of behavior. Here you go. The market runs up. This one is better than this quality because it's happening kind of to the conclusion of this harmony wave. However, at the beginning of a new harmony cloud, and the market just reacted to it, market sold off. This is a trigger trade, never got to the middle of the range, and off you go. You got about 10 points. Market runs up, gives you that type of behavior. That's another railroad short, and the market responded into another railroad that happens to be also a captain setup. So you see that type of behavior happen from time to time. So a minimum of 2 candles, you hit that level, you come back in here. An entry there had a stop of 1 tick above that level, and it never hit it. It got very damn close to it, but it never hit it. And then you got a positive reaction. Then here, you got at the end of this harmony wave, you got another railroad, and that one fails into higher prices. So this is why it's so important to take that first reaction. So again, if you have one trade to take, what would that look like? It would look like this one right here. Okay, the cloud shifted from positive to negative, and you got that reaction. The cloud shifted from positive to negative, and that was the first reaction into it. So versus this right here, where the market already made that reaction, and this is at the conclusion of the harmony wave, and then they, end up, stopping you out just to kind of turn the market around and sell it off. Okay, so that's just let's see if we had any. And today, pretty much, there's no longs to be had anyway, because the market was just very short. So that's in essence the railroad long and short, and the trigger long and short. And what I suggest you do is spend some time, put about 30 days worth of candles in on your chart, and go and highlight every railroad and every premium railroad, and then look for trigger trades and how they would have helped your initial position from a premium railroad signal. And we can discuss those in our next meeting. And if you have any questions, you can reach me at support@harmonytrading system.com, and we'll see you on the next one.